Right now, Microsoft is trading at its cheapest valuation since 2023. And it's entirely because the market is terrified. Investors are looking at this projected $115 billion annual infrastructure spend. They see the massive scale of AI data centers being built, and they're panicking. They think Microsoft is overbuilding way ahead of actual demand. But here's the thing. They are completely ignoring a massive, pre-sold reality that's hiding right in plain sight. Let's get into this because the core tension driving the stock price down, it's built on a fundamental misunderstanding of how this company actually funds its growth.
Look at this number, $678 billion. That is Microsoft's commercial backlog, also known as its remaining performance obligation, or RPO. Now, this isn't projected revenue. It's not some hope or a guess. These are signed multi-year, contractually secured commitments from corporate customers. So whenever you hear the market panicking about Microsoft spending billions on data centers, just remember this number. It makes the current capital expenditure panic mathematically irrational. Why? Because those data centers, they're effectively pre-sold before the concrete is even poured.
And this perfectly illustrates the central conflict we're unpacking in today's explainer. On one side, we have the market's biggest fear, speculative AI overbuild. The bear case basically argues that Microsoft is just throwing hundreds of billions at GPUs and servers, hoping the demand eventually shows up. And if it doesn't, margins will absolutely collapse under the weight of asset depreciation. But contrasting this fear is the reality we just looked at. Microsoft's Capex is actually demand-led. Corporate clients are literally waiting in line for server space right now, and public cloud capacity is expected to remain supply-constrained all the way through the end of calendar 2026. Part 1. The engine. Inside the $1.3 trillion opportunity. To really understand why the market is mispricing this risk, we have to look under the hood at Microsoft's economic engine. How do they actually convert all this capital expenditure into secured corporate revenue? Well, Microsoft is structured around 3 primary segments, but the ones that really matter for this story, the ones driving that high-margin enterprise spend, are productivity and business processes and the intelligent cloud. And what's wild here is the sheer scale of the runway. Internal valuations based on IDC data project the total addressable market for fiscal year 2027 at more than $1.3 trillion. You've got $566 billion in large enterprise contracts, $175 billion in the mid-market, and a staggering $625 billion opportunity in the small and medium-sized business space. Microsoft attacks this massive TAM by selling software as a service subscriptions, like Microsoft 365, and consumption-based public cloud compute through Azure. And increasingly, they're layering high-margin generative AI capabilities right on top of both. But TAM doesn't mean a thing if you can't defend it. So the crucial point here is the depth of Microsoft's protective moat. First off, you have unmatched switching costs. Once an enterprise integrates their identity governance with Active Directory, standardizes workflows on Teams, and runs their data lakes on Microsoft Fabric, ripping all that out is an absolute operational nightmare. Second, their global scale lets them build custom networking and security silicon, which drives down costs. Third, and this is massive, they hold exclusive Azure API hosting rights and extended model IP rights with OpenAI all the way through 2032. They are literally the essential gateway for the world's frontier AI models. Part 2. The evidence. Q4 fiscal year 26 earnings breakdown. Let's look at the hard evidence and see how this actually translates to the bottom line. If the enterprise migration to cloud and AI was stalling out, like the market fears, it would show up in the numbers, right? But on July 29th, 2026, when Microsoft reported their fourth quarter and full fiscal year 2026 results, the numbers completely shattered that slowdown narrative. Total revenue for the quarter hit $90 billion, an 18% increase year over year, beating estimates. Non-GAAP earnings per share came in at $4.74, nearly a 12% upside surprise. But check out the standout metric here, that 43% growth number for Azure. The market was bracing for sub 40% growth, and Azure blew right past it. On top of that, paid Microsoft 365 Copilot seats expanded to over 30 million. The demand isn't theoretical, it is showing up in the current quarter's cash flow. And hey, just really quick, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed. Yet, despite blowing past Q4 estimates, despite generating over $55 billion in operating cash flow for the quarter, and despite management guiding for double-digit revenue growth next year, the stock barely moved. It closed that day at $394.83. Why? Because Microsoft also announced they're raising their fiscal 2027 Capex to between $255 million and $260 million to meet constrained supply, and the market got spooked. That fear brought Microsoft's trailing price-to-earnings multiple down to an astonishing 22x. Just for some context here, Microsoft's historical 5-year average PE is between 32 and 35. Part 3. Qualitative Analysis, the Business Scorecard. So we clearly have a valuation disconnect on our hands. But to know if that 22x multiple is truly a bargain or just a value trap, we have to look beyond the quarterly numbers. Let's evaluate the qualitative structural health of the franchise. Based on the research framework for this explainer, Microsoft scores an incredibly rare 9.1 out of 10 for overall business quality. And the standouts here are exactly what we want to see when a company is spending heavily. Revenue quality gets a 10 out of 10, all thanks to that massive $678 billion commercial backlog providing unprecedented visibility. Business viability? Also a 10 out of 10, because these are essential software platforms. Enterprises cannot simply turn off Windows, Office, or Azure without basically ceasing to function. And their market position sits at a solid 9 out of 10, as Azure continues to close the global infrastructure market share with Amazon Web Services. Basically, this is an elite franchise trading at a major discount. Now, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at FlashStockSentinel.ai. The core company research is free, but if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses, hidden gems for asymmetric upside, and dividend hunters for durable income. Premium also gives you Portfolio Watch to monitor your portfolio for important changes, and Insider IQ to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flashstocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Part 4. 5-year Scenario Framework, from Fiscal 26 through Fiscal 31. Okay, let's look at where this is all going. We're going to map out a 5-year scenario framework from fiscal year 2026 through fiscal 2031. But before we start, I need to clearly state this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. So to build these scenarios, we don't just guess a price target. We use a clear operational to valuation bridge. First, we take Microsoft's FY26 base revenue of $331.8 billion and grow it by a projected compound annual growth rate over 5 years. Second, we apply an assumed net profit margin to find the year 5 net income. Third, we divide that by the projected outstanding shares, factoring in their historical buyback yield to get our future earnings per share. And finally, we multiply that year 5 EPS by an assumed exit PE multiple. This connects the operational reality directly to the implied future share price. Here are the operational assumptions for our 3 cases. In our base case, which we assign a 55% probability, we assume steady cloud migration and solid adoption of Copilot. Revenue grows at a 13% CAGR to $611.3 billion. Net margins stabilize at 38%, and we apply a very normalized 23x exit multiple. That gets us to an implied price of $748.57. In our high case, driven by accelerated generative AI integration, revenue hits $727.5 billion, with margins expanding to 41%, driving the price to over $1,181. But look closely at the bear case. If enterprise AI adoption stalls and the Capex overbuild triggers massive depreciation, margins compress to 30%, and the multiple crashes to 16x. That drops the price to $308.27. And by the way, if you want to access the full model with all the detailed line item assumptions for each scenario, you can check out the detailed research report at flash.stocksentinel.ai.
And this brilliantly illustrates the risk-reward profile over the next 5 years. From a starting price of $394.83, the base case offers a near 90% total return, or about 13.6% annualized. Even if things go poorly in the low case, the downside is modeled at around negative 4.8% annualized, largely because the current 22x multiple has already de-risked a whole lot of that downside. When we apply our probability weighting across all 3 scenarios, the expected 5-year target sits at $768.84, which works out to a 14.3% annualized return.
Part 5. The Thesis Breakers. Now, as investors, we can never just focus on the upside. We have to explicitly address the downside risks. We need to know what would actually break this thesis and cause permanent capital impairment.
Interestingly, the ultimate threat here is not macroeconomic. Microsoft's software is just too critical. It largely buffers them during normal economic cycles. No, the real thesis breaker requires two things happening simultaneously: a structural decline in enterprise software utility, meaning AI just doesn't deliver the return on investment corporations are hoping for, combined with aggressive regulatory unbundling. If antitrust regulators step in and force Microsoft to separate its integrated ecosystem, say unbundling Teams or security from Azure and Office, that essentially lowers their switching costs entirely.
So, what are the concrete early warning signs we need to watch for? First, keep a close eye on consolidated operating profit margins. If they compress below 44%, it means depreciation from that massive $115 billion asset footprint is outpacing active sales. Second, watch corporate trial-to-paid conversions. If Microsoft 365 Copilot paid seat additions suddenly stagnate, that's a severe danger signal that those massive infrastructure investments are going to remain severely underutilized. Third, monitor the news for formal regulatory action specifically targeting ecosystem bundling. And finally, watch the balance sheet to ensure outstanding debt isn't expanding faster than operating cash flow just to fund these data centers.
Part 6. The final verdict.
Let's bring all these threats together. The market has been treating Microsoft's massive capital investments as a speculative gamble, punishing the stock and compressing its valuation to levels we haven't seen in years. But the evidence we just went through tells a vastly different story. Here are the three most vital things you need to take away from this explainer. 1. A projected $115 billion annual Capex spend is not some blind gamble when it is backed by a contractually secured $678 billion commercial backlog. 2. Microsoft's RPO to Capex coverage ratio sits at an incredibly healthy 3.5x, deeply mitigating the risk of an infrastructure overbuild. And 3. At 22 times trailing earnings, the market is severely mispricing this demand-led growth. Yes, the fear is real, but when you look at the secured enterprise demand, that fear is fundamentally irrational. Going forward, the single most important thing to watch is that M365 Copilot seat growth. As long as enterprises keep paying for seats, this economic engine just keeps humming.
If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai.
So the question isn't whether Microsoft is spending too much on AI today. The real question is, can you afford to bet against the company that already owns the enterprise infrastructure of tomorrow? Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.